Okay, so we could have gone over this slide in the previous video, but it was already way too long. So we're going to go over it now instead. If you were paying attention and rewatched part of that, you had everything that you needed to answer the in-class handout, which I guess is not in class anymore. So we have a balance sheet here, and it says that it is a partial balance sheet if we look down here in the green portion. And that's because it only represents stockholders' equity. So it says here that under paid-in capital, we have common stock that totals $2,000. And that is a true statement. It is $1,000 for the first 1,000 shares that we issued strictly at par at $1 a piece. Then we had the second transaction where we issued another 1,000 shares of $1 par value common stock. So that's 2,000 shares times $1 par value gives us our $2,000. But if we recall, that second 1,000 shares that we sold were sold for $5 a piece. Par value was $1 per share, but we introduced this new account called paid-in capital in excess of par, and we said that $5,000, well, that's $1,000 times 5,000, minus the $1,000 par value was in fact $4,000. So our total paid-in capital portion of the stockholders' equity section of the balance sheet is $6,000. $6,000. But as we said a few slides back, stockholders' equity has two components: paid-in capital and retained earnings. If you don't believe me, you need to review the previous slides, either in the PowerPoint presentation that I've provided or in the PowerPoint video that's been uploaded, either way. So retained earnings, it shows $27,000. Where did that number come from? I don't know how they came up with the specific total of 27,000, but I know what the 27,000 represents. That is all of our earnings to date from the beginning of time that this company has made, that they have actually retained. So if we had it, let's just pretend for a moment that this was a brand new business, and we had $27,000 of net income for the year, and that would just leave it real simple like that. Then our retained earnings for that first year would match net income, 27,000. Maybe this is the second year of the business, and we had net income of 13,000 the first year and net income of 14,000 the second year, and we retained all of that. Well, then our retained earnings would be 27,000. 13 plus 14 is 27. Add the $6,000 paid in capital with the $27,000 retained earnings, and we come up with $33,000 total stockholders' equity. All right. So we just talked about retained earnings, and I said we were going to pretend or assume that this company had retained all of its earnings. We were keeping it really simple. But the fact of the matter is that that's not really what happens. People invest in companies when they become owners of the company, when they become stockholders of the company. They tend to, assuming that the business is making any money at all, they kind of want to get some of that investment back, and they generally do that via what we call dividends. You may also hear this referred to as owner draws, owner withdrawals, or distributions. Okay, so those are all synonyms. Okay, so if you have a small business and you go to the bank and you write yourself a check for $500, you just paid yourself a dividend. But usually what we talk about when we talk about dividends is when we invest in a larger company and they send us a dividend check periodically out of company earnings, okay? Now, for purposes of this class, we are only going to focus on this number one item here under types of dividends, cash dividends, okay? Cash dividends. And what happens when we pay cash dividends? What has to happen for us to be able to pay cash dividends? These are all facts that we need to become familiar with. All right. So we've got some requirements here. It says for a company to pay a cash dividend, it must have sufficient retained earnings. Now this is not completely the truth, but for what is called a regular or normal dividend payment, this is a true statement. So in our previous slide, or a couple slides back, we saw that we had retained earnings of $27,000. Well, in that situation, we would be limited generally to an absolute maximum dividend payment of $27,000. Number two requirement says adequate cash. I want you to understand that retained earnings and cash are two separate amounts. They are not going to be the same, and if they are, we call that an extreme coincidence. Okay? So we had in the couple slides back, we had retained earnings of $27,000, and I told you just a moment ago, I said that we're probably going to have at the most we could pay out was $27,000 in dividends. At the most, your retained earnings usually for a mature company is going to be a far, far higher figure than actual cash on hand. Okay, because cash is just one of our assets. So we have to have enough cash to pay out the dividends. Hopefully this is common sense. If we decide that we're going to pay out $8,000 in dividends and we only have $5,000 in the bank, we have a bit of a problem on our hands. And then finally, number three, we have to have a formal declaration by the board of directors for the company. You say, wait a minute, you just said a minute ago if an owner goes and writes himself a check for $500, he paid himself a dividend. What about the board of directors? Well, in a small business like that, he's the owner. There is no board of directors. So when we talk about a declaration by the board of directors, again, we're talking about these larger companies, publicly traded companies that sell their stock on a stock exchange. Okay? All right, so we have some important dates here. And this is something that if you do not review this, you are going to mess it up on the exam. These three dates that we need to be concerned with is declaration date, which we'll sometimes hear called the date of declaration, the date of record or the record date, and the payment date. Okay, now, this first one, declaration date always comes first of these three. In this particular situation, we're using the date of December the 1st of whatever year this is. And on that date, the board of directors authorizes the payment of dividends. We'll say that they're going to pay 25 cents per share, or that they're going to declare $10,000 in total of dividends to be paid out. Okay? So that is the date of declaration. This is important because this is when the liability is incurred. They haven't paid the money out yet, but listen to me very, very carefully. This is when our liability takes place. Date of record is always after the date of declaration. I say always, it doesn't have to be, but it usually is. here our date of declaration is, our date of record is December the 22nd. Date of record is the 22nd. All registered shareholders are eligible for a dividend. So you can actually find a company that declares a dividend on the first of the month, and then you can buy dividends on the, say, the 19th of that month, and if the date of record is the 22nd, you're going to get dividends. You're going to get dividends based on this declaration over here. Okay? Companies do that on purpose to get you to buy the stock. And then finally, the payment date, which was established over here actually. In this case, looks like it's January the 20th. This is the date that the company actually pays the dividends out. Okay, mails the checks, so on. All right, so we have an example here. It says on December 1st, the directors of Media General declare a 50-cent per share cash dividend on 100,000 shares of $10 par value common stock. Okay? The dividend is payable on January the 20th of the next year to shareholders of record on December the 22nd. On December the 1st, the declaration is as follows. So, no money has been paid out. They've got $50,000 here. Where did they get that? Well, this $10 par value here doesn't matter. All we have to have is the number of shares, 100,000, in this case, multiplied by the amount per share. 50 cents times 100,000 is 50,000. So on that date of declaration, December the 1st, we established a liability, dividends payable, of $50,000. Again, this is the accrual basis of accounting. Therefore, retained earnings is reduced immediately. Retained dividends have actually, it has a negative sign here, dividends have actually gone up. But as dividends go up, cash dividends go up, retained earnings go down. Okay, because we have no longer retained those earnings. We're getting ready to pay them out in the form of $50,000 cash. Okay? Now, let's fast forward a little bit. On, January the 1st, we're actually going to make that payment. So at this time, we have two accounts that are impacted. When we made the declaration, we increased liabilities and decreased owner's equity, decreased retained earnings, okay, for $50,000. Now, when we pay, we're going to decrease assets, specifically cash, by $50,000, and we're also going to decrease dividends payable. Okay? We do not touch retained earnings or stockholders' equity at all because we've already done it. Okay? So here we have our December 1st transaction and our January the 20th transaction. There is nothing that actually takes place here on December the 22nd. That's just merely saying that if you own stock as of December the 22nd, you are eligible for these dividend payments. Okay? All right, so review question that says entries to record cash dividends are required on the what? Entries to record cash dividends are required on the, think about it, be careful here. Let's see if it gives us the answer. If not, we'll have to come back. It did. Answer is D, the declaration date and the payment date. Now I want you to understand that the cash account is only impacted on the payment date. Okay? But we set up the liabilities on the declaration date, and we also hit retained earnings. In our example, it was for $50,000. So cash dividends reduce retained earnings. Therefore, we will have two different places where cash dividends will require an entry: date of declaration and the date of payment. Okay, got an example here for dividend preferences. This is information that you probably need to have. I believe this is the last slide that we have any questions from, but it says preferred stockholders have the right to receive dividends before common stockholders. So what we want to understand is that preferred stockholders have superior rights to common stockholders as to dividends. Okay? And I believe the rest of this slide is stuff that we're not going to get into cumulative preferred stock or anything like that. Okay? Let's see what else we have here. It does give us an example of how we might pay out some dividends. If we were to declare a $60,000 cash dividend, this $60,000 cash dividend is the total amount of cash dividends that are going to be paid out. Okay? And we have to look and we say, okay, well, looks like we said that preferred stockholders have superior rights as to dividends, so we calculate the preferred stockholder share first. There are 2,000 preferred shares, and they get a 6% dividend based on the par value of $100. So if we take 6% times 100, that gives us $6, and we multiply that by the number of shares, that's 12,000. So the first $12,000 goes to preferred stockholders, and then the remainder, the $60,000 declared amount minus the $12,000 the preferred stockholders got, the $48,000 would go to the common stockholders. All right, and then finally, the last thing that we're going to discuss is we have some, looks like we have some advantages, disadvantages of raising capital by a couple of different methods. When we talk about bond financing, we want to understand that the advantage of bond financing is that we have not sold any of our company. We've borrowed money, but whatever percentage of the company that we currently own, that has not gone down. Whether we own 100%, 50%, whatever the percentage is, we still own that. Okay? Now the disadvantage to bond financing, all right, is that we've created a liability. Okay? So what we're trying to do here is we're trying to show you the differences between equity financing or becoming a stockholder, buying into a company, and loaning a company money, becoming a bondholder. All right? Bond financing does have some tax savings result. Bond interest is tax deductible, so that is our advantage. The disadvantage is that we're having to pay the interest, however. Okay? And then finally, we've got return on common stockholders' equity may be higher. So it says, although bond interest expense reduces net income, okay, and that is most definitely the case, any type of an expense will reduce net income. Return on common stockholders equity often is higher under bond financing because no additional shares of common stock have been issued. So what we're talking about there is this concept of dilution. So the fewer number of shares that are out there circulating, the more each one of those shares gets to share in company earnings, okay? So what we're essentially saying in this third point is, yes, this interest expense does reduce net income, but it might be worth it if we're talking about this concept called earnings per share. Earnings per share is likely to overall increase if we use bond financing versus selling additional shares of stock. Again, the disadvantage, the flip side of this is stated right here, that bond interest expense reduces net income. All right, so that does it for Chapter 8. You should have now all of the information that you need to answer the second side of your second handout for the week.